Welcome to Richard Suttmeyer's 4 in 4. 4 blips on my radar screen presented in 4 minutes or less. My first blip explains why I disagree with Wall Street's call that the worst is over for the credit crunch. Last week, CEOs of Goldman Sachs and Morgan Stanley indicated that banks were in the fourth quarter or ninth inning of their climb to recovery. Yesterday, the CEO of Lehman Brothers said that the worst of the impact on the financial services industry is behind us. I disagree, as the National Association of Home Builders chimed in with their Home Builders Index, which is flatlined at a reading of 20, a level tough to break under given a neutral reading is up at 50. Home builders are not even seeing a bump in sales at the beginning of the prime spring season for home sales. The Beige Book is released today for the April 28-30th FOMC meeting and will show continued concerns about further deterioration in financial conditions and note the downside risks to economic growth. As I've been saying, Wall Street CEOs don't know what they don't know. My second blip describes the problems just in the mortgage portion of the Great Credit Crunch. U.S. foreclosure filings jumped 57% and bank repossessions more than doubled in March from a year ago. March was the 27th consecutive month of year-over-year increases in monthly foreclosures. Sources say that $460 billion of adjustable rate mortgages are scheduled to reset this year. In addition, home auction notices rose 32% year-over-year, which is a sign that defaulting homeowners are just walking away. According to Lehman Brothers, about 2.5 million foreclosed properties will be on the market this year and in 2009. Home price declines will likely double to a national average of 20% by next year. About 8.8 million borrowers have Diana Ross mortgages, upside down and inside out. As the value of securities tied to mortgages plummet, lenders and securities firms will find more write-downs, which so far has totaled at least $245 billion since the beginning of 2007. My third blip reiterates the other types of loans that loom as additional waves to the Great Credit Crunch. Community and regional banks are exposed to $968 billion in non-farm, non-residential real estate loans, mostly collateralized by apartments and office buildings. Community and regional banks are exposed to $629 billion in construction and development loans, which are mostly residential properties not yet ready to be a new home sale. There are $607 billion in home equity loans, and Wells Fargo has a huge portfolio of these. They report pre-market today, and I will blog about that later this morning. There are 165 notional amount of derivatives contracts just among the FDIC-insured institutions. I will blog about what JP Morgan has to say about their record amounts that they originated, if they choose to mention it. My fourth blip is summarizing that it will take years to unwind the Great Credit Crunch. In prior 4 in 4s, I have described the situation from several angles and have offered possible solutions. The problem is that everyone's looking for quick fixes that just do not exist. The experts don't look at the FDIC data and thus ignore the major exposures I see. Send your comments and questions to support@rightsideadvisors.com. That's today's 4 in 4. Enjoy your day.